the earlier you go, the more important it is to capture someone the moment they go into stealth, the moment they start a new company, etc. And kind of like, whereas a company has existed for quite a while, that becomes substantially easier. They've been in the news, they might have a LinkedIn page, there's definitely a website, stuff like that, right? However, we try to go a lot earlier than that. So basically kind of like the moment a company gets incorporated, essentially the moment someone thinks about starting a company, that's when you really want to hit the ring.
So hi everyone, many thanks to be on Aulium again. I'm with Markus one more time. Another great episode, I'm sure, because we are joined by Jacob, one of the founders of Evertrace, Danish software company focused on helping VCs discover the next unicorns in the market. So Jacob, very nice to have you on board, and I hope all is well.
Thank you very much. Pleasure being here.
Markus, always the same, super nice to have you with
back.
me.
Hi, Jacob.
Pleasure to meet you, Markus.
So maybe to kickstart the discussion, I guess a super easy question for you, Jacob. Can you describe Evertrace in a few words? I think that would be awesome, just to understand what you guys are doing.
Yeah, absolutely. So essentially what we do is we help VC funds, so early stage investors across the world, identify new potential investment opportunities. Quite a niche market, but a pretty hard problem to solve, because the earlier you go, the more important it is to capture someone the moment they go into stealth, the moment they start a new company, etc. And kind of like, whereas a company has existed for quite a while, that becomes substantially easier. They've been in the news, they might have a LinkedIn page, there's definitely a website, stuff like that, right? However, we try to go a lot earlier than that. So basically kind of like the moment a company gets incorporated, essentially the moment someone thinks about starting a company, that's when you really want to hit the ring, because that's what's important to our clients, that they get in front of the right people as early as possible, which is extremely important previously, but has only grown more important as kind of like the space continued to evolve and essentially grow even more rapidly than it has in the past. So that's in a nutshell what we do. We just help early stage investors identify new potential opportunities.
So in terms of product, I mean, what does it look like? It's a platform, maybe some sort. And I guess it's quite different from a Crunchbase, let's say, which is probably more descriptive.
Yes.
You add more intelligence in the mix.
Yeah, so I mean, the way we serve and kind of produce our content is on a platform, and you can think of it as like a Twitter feed, but instead of it being about your friends and family posting random stuff, it's just new companies, new founders, etc. coming up, right? And that also fits quite well with the thesis of you want it to be as early as possible. That also means we don't just upload data once a week or once a month. The data is much more feed-based, which means that it's continuously updated. That also means that our customers, they check our platform. So the common way our customers use it is they'll log in every morning and they'll see what's new since last day, or they'll log in twice a day and they'll see what's new in the last couple of hours. And then you get literally a feed of these people started companies, and then you put the customers will then apply a filter on it, or a search criteria, I want to see in these industry, with these backgrounds, with these countries, these nationalities, etc. Right? And then you get a much more curated feed of potential investment opportunities, right? Because so we have kind of the full data layer underneath. We actually screen out kind of all the more irrelevant stuff like consulting companies, brick and mortar stores, stuff like that. However, there's still a lot of companies, right? So what you want to do as a VC fund is you want to apply kind of your investment thesis on top. So it might be a Danish one. I invested people in Denmark, but I also invest in Danish founders abroad in these three industries. And that's essentially what you do. So you make it super narrow. So you only get the kind of the profiles that are relevant to you, get served in a feed. You check it once a day, and your sourcing is essentially done. So that is pretty much kind of our promise, right? So it's lowest possible lead time from when something happens to when it appears on our platform. Highest possible coverage ratio. So we want to make sure that we cover all the right and all the potential relevant investments for you. And then the last thing, which is where the magic really happens, is you want to make sure there's least amount of noise, right? Because we evaluate all new companies incorporated in Europe and also in the US. which means that just like there's thousands and thousands and thousands of companies a day, and you'll get completely inundated with all of those having to scroll through those, right? So we filter out all the noise, only serve what's relevant to you as a VC investor. So that's in a nutshell, right?
Yeah, that's super interesting, Jake. I actually, I wish I would have known about this platform when I was raising. Sounds like it would have saved me so much time. Yeah, it's really interesting. And I guess, you mentioned already there's a big element of audience that you help with in the thesis to make sure you don't spam too many VCs that are not relevant, for example. But then do you also help with the follow-on processes after that, for example, with the messaging and maybe the structure of the message and how that goes out?
Yes, I mean, so for example, like a typical VC flow, right, would be they identify a company, they research the company. It's like, this is actually relevant, and then they'll reach out and then they'll have meetings. And right now we do the identification. There's also a little bit of kind of like helping to make sure that they're in your scope, right? That's why we add tags, we add industries and stuff like that. And then the last piece is like reaching out, for example, over email. That piece is we're actually working on right now to make sure that kind of like the entire manual process becomes as automated as possible. Because a lot of this stuff, like, that's not really what VC funds or VC associates they enjoy doing, right? Like identifying companies and writing people on like emails is just not really fun. It's mostly just fun talking to founders, digging into their business, stuff like that. So essentially we're just helping to like remove all the less interesting components of their work and then make them much more efficient. So that, I mean, that is very much kind of like on the docket. I think it's going to be released in Q1 this year.
So maybe like before you release like Evertrace, I mean, what would, as you mentioned, like associates within VC firms, I mean, what would they have to do, like, really to essentially spot founders? What would they have to do manually? If you could describe maybe, because I mean, you lived you lived like essentially the pain point being a VC yourself. So yeah, what did you have to do, or maybe your juniors had to do manually, and what do you automate now essentially? Like, if it would be interesting to understand.
Yeah, and I mean, it actually ties very much into kind of like the fundamental why are we building this business, right? So I think there's essentially two answers to that question. The first one is essentially what you just said, Thomas, which is there is a ton of manual processes. Before that, what you'd have to do is like you'd probably go on LinkedIn. You'd find like who has started new companies, but you'd also like reach out in your network. You might, if you're a little bit more savvy, tech savvy, you'd hook up to like one local trade registry. And then you see like who has created companies, and then you'd have to troll manually through all those newly created companies on, for example, the Danish trade registry. Be like, this company is relevant, and you have to find the person, and you have to write them. So essentially all of this gets like completely taken out. And instead of like having any manual process here, it just becomes extremely automated. You get all of this served directly into your feed. So like it just takes all the manual labor and then just removes it. And then the secondary piece on why we decided to start Evertrace is because back when we were there's quite a few funds who actually generated alpha just from their sourcing, right? And sourcing is essentially, we consider it a descriptive problem. So like it's just basically describing the world as it currently is today, right? Like these people have started a company, these people are going into stealth, etc. Which is, it's complicated, but it's a solvable problem, much more than a predictive problem, which is basically saying, this is going to be a unicorn, this is going to be a great company, etc. And deriving alpha from a descriptive problem just feels fundamentally not really market efficient, right? And so the whole point of Evertrace is to solve the descriptive problems, but essentially moving kind of like identifying the right startups early from alpha to beta. And that makes it much more like you level the playing field. Everyone has access to the same deals. And then the only thing that matters is one, can you deliver value to get into the good deals? And then two, can you identify what the good deals are ahead of time, right? So it moves all the alpha towards the predictive problem instead of a descriptive problem. And essentially that's why we started.
Okay, so I mean, you I think you announced like very recently that you reached already like 150 clients, which is quite like a very big thing. So I mean, really congrats on this in such a short period of time. I mean, maybe fast forward, let's imagine the entire VC world is equipped with Evertrace, so everybody has the same access to the same information. You said that, to be a good investor, I mean, I guess to be a good investor, you have to do two things. Find the potential gold mine, and then work on the gold mine and to extract the gold. So if you take away the fact that everybody has access to the gold mine, you essentially, I don't know, withdrawing like maybe 50% of your chances to make some sort of difference for your actual LPs or backers as a GP, as a venture capital firms. What sort of place do you live after this? Really?
Yeah. I mean, if we have to kind of like continue with that allegory, right? Essentially, what we're providing everyone with is a map. So back in the days, everyone would be like having like a map that's half filled out. You have no idea where anything is. You don't know what is land, what is like, so you don't even know where to potentially look for gold, right? And what we've basically given everyone is just a map of like, this is all the potential gold mines. Now it's up to you to identify, is there gold here? And if there is gold, how do we best extract it? So we see ourselves much more as like just leveling, but you still have to decide what companies to invest in, right? Because there are so many companies, and we don't go in and we say like this company is going to be a unicorn, or like this is going to be your 10x or 100x. So we go in and we say like this company does something that is within your investment thesis. These founders have these particular background, which is also something that we look for. This could be a fit, but you take the final decision. So there's less kind of a we screen out stuff that's obviously irrelevant, but the moment something potentially is irrelevant for you, it's up to you to actually evaluate whether you want to invest or not. And I think that's much more fun as a VC investor. And two, I think that's also where the value should be, right? It shouldn't just be because you got to a company first that you like, that's kind of like your competitive edge. Your competitive edge should be that you are able to pick the right ones once everyone knows them, and then you're able to help them kind of on their journey to becoming like a massive company. So I think there's still tons of value left on the table for all the VC funds.
But I mean, we definitely shift in some way. Maybe like the industry was more of, explorators and, adventurers in some way. Like you go in places and you sort of hand down the next opportunity. And now
For sure.
essentially like contributing to make it more mature in some way.
No, I fully agree, right? And I think there's also just there's something about like you give access to companies earlier, right? So companies doesn't have to wait as long time before they get capital. More non kind of like in the know people should also have an easier time getting capital, especially if you're like a deep tech startup started at like a university spin out, doesn't really know anything about venture. It's much easier for you to just get discovered without having any knowledge about like the VC world, right? So I think it's positive for the VC funds because they can streamline their operations, they can get access to more deal. It's also positive, like it's very positive for the founders because they get in front of many more VC funds a lot earlier.
Yeah, that's really interesting. And we actually had a founder on the podcast a couple of weeks ago who founded a company called Clarity, and he was mentioning that actually, in the US, it's been quite standard to proactively outreach to businesses to attract them and for investment. Whereas in Europe, maybe it's something that's just being done recently. Do you feel that VCs that are going to be successful in the future are going to be the ones that proactively reach out?
Yeah, I mean, I'm supposed to say this, right? But that's definitely kind of also when we talk with our customers, like what everyone sees is that it's the deals that you hunt yourself that are just better than everything else, right? At the end of the day, there's a little bit of a negative selection bias for everything you get in, because everything that reaches out to you will have a tendency to not have been able to raise capital elsewhere. Sometimes you find really, really good companies there because they can kind of go under the radar. They might have a little bit of a different profile than what is normal. But oftentimes it just means that it's the people who can't raise capital, and they can't raise capital for a reason. So like you going out and hunting super early also means that you're able to kind of like pick and choose much more than just get all the stuff that the other people don't want to like really touch, right? So I think it has definitely changed the nature of VC over the last couple, like 5-10 years, to be much more proactive versus reactive.
So one very interesting thing I believe about like Evertrace is like, first you are bootstrapped, but you are relatively young, but you also are extremely active in terms of so you essentially have like a relatively like very small like core team. But over the past like 18 months, I think you've done like 3 acquisitions already. So Morpheus, sorry if I pronounce it badly,
It's
but
all right.
Seedpoint and Whisper AI. Do you think you could maybe walk us through the rationale and the logic behind this? I mean, because you were in VC, so one could believe you would have like some sort of a bias towards raising money, because you knew that if you have money, you can go faster. You're actually not doing this at all. So yeah, if you could explain essentially how that came out, would be quite interesting.
Absolutely. So yeah, I get your point that it's kind of it's a bit ironic, right? That we all we worked in VC and we've decided basically to be bootstrapped and raise a very small amount of capital. Very happy to talk about that, but that's mostly about our market and the kind of company structure we're going after. I still think VC money is extremely good for specific companies. But kind of coming back to the M&A strategy, it's probably a little bit influenced by our backgrounds. So before that, I worked at Bain. Before that, I worked in investment banking, so kind of have seen employed as a growth lever. So I think that's number one, just kind of having had exposure to this area. And then the secondary piece is that our space and kind of some of the companies we bought has just been extremely ripe for consolidation. So we've been very targeted about the companies we buy. So all three companies essentially produce a product where the outcome is the same as ours. It might be packaged a little differently. So we focus a lot on founders that start companies. Some of these companies we bought focus on companies created by founders. But essentially it's the same thing, right? It's just what you want is to identify new potential investment opportunities for early stage venture funds, right? So the product or the promise of the product is very, very similar, which means also that the client is extremely similar. And they don't have any kind of offshoot products. So that makes the entire process very easy, because the integration then is basically just you take their customers and then you have an intro call with all of them and then you roll them over to our platform. And then you roll them over with the promise that you'll have everything you had before, but now it's just combined with ours. So it's just fundamentally going to be better. So a typical integration process takes the full from start to finish takes 3 months of 2-3 months of negotiation, and then a few weeks of onboarding. While we negotiate, we make sure that the platforms have feature parity. So the customers just get on to a better experience. We look at what data sources they have, and then we integrate them into our flow. And then we basically just roll the customers over one by one by one. So the operations and the integrations becomes extremely simple, because we don't have to keep 2 things running at the same time. We don't massively expand our team, anything like that. And then on the deal execution side, I'm obviously able to kind of do some of the financial stuff, some of the operation stuff, some of the strategic components. But then our chairman is a lawyer, a former venture lawyer. And we have a partner from a Danish law firm on our cap table as well. So they help on legal stuff. So we can kind of keep almost everything in-house. And that just makes kind of the execution portion of the deal also extremely simple. Mm-hmm. The entire process becomes very lean. And obviously kind of the first time we did it, there was more things to learn, but now we've done it 3 times. So now it's pretty much just kind of a playbook. Mm-hmm. And we plan on ideally buying a few more companies this year, and then essentially just applying the same playbook to the new companies we buy. So just execute the deal, integrate the sources, and then roll over the customers.
Okay, understood. I mean, so now I guess your life will be much easier, to run deals, because you've done it before. I mean, when you start and you have a bit of credential and track record, I mean, it's easier to essentially go and speak and convince other entrepreneurs. But how did you make it happen for the first one, where essentially I would assume, maybe I'm wrong, but you didn't have 100 million to put on the table cash to acquire the product. I'm not saying that you would have done that if you had 100 million in the bank account, but so
that's fair.
Everything to say that maybe you didn't have let's say the massive firepower to essentially convince someone with actual paycheck. How did you make it happen? I mean, at the end of the day, it's a very sort of relationship, human, emotional thing. So how did you make it happen? I mean, did you have some failure and then, or did you get it right the first time? If you can, explain to me how you did. I mean, I'm super curious. I mean, personally speaking, I'm quite interested by, roll-up strategy, buy and builds, etc. So, but I'm super interested in how entrepreneurs make it happen for the first or the 2 first acquisitions, which I believe I believe not like I'm a genius, but are probably the hardest one.
Yeah.
So how did you make it happen?
So first of all, I fully agree, right? The first one, it just took longer. One, because I mean, I've done deals before, but it's different scale, right? Different team size, different companies. So there's a little bit about like going into the process and saying like, I've worked with this kind of stuff before. I haven't done it in this context, but I've done it in other contexts where it's been successful. So it helps kind of have some credentials, right? And then there's number two is that the first time it just takes longer. You have to be ready to kind of like talk with the company you want to acquire over a longer period of time. You have to like convince them or like discuss through kind of like the benefits of it, right? And then coming back to kind of your earlier point of how do you actually structure the deal. So you'll have like three components. The first component is cash. Obviously, we can't, as you say, right, we can't pay like $100 million. It's not feasible. We literally don't have that balance sheet. The secondary piece is then equity, and then the third piece is an earnout model. So those are essentially the three kind of like structures that you have to play with, right? The three levers. And the equity piece feels the cheapest, but it's actually the most expensive because you're giving up part of your company. And then the earnout is really where it's the hardest to convince someone of, because essentially at that point they're just like, you're taking over their customers. And then they have to believe that your product or the combined product is going to be much better serving those customers than they are themselves. And I think that piece requires actual convincing. So that's a lot about like we always played with quite open cards. We invited them to the platform. They could see it. They can click around. They'll see like, this is the product. This is the roadmap. This is what we are going to do. And we were also very kind of upfront about like, this is how we're going to run the integration process. This is how we're going to talk with your customers. This is how we're going to integrate your product into ours. And then it basically becomes like a long kind of like discussion about one, how do you structure the deal so they feel like they have some downside protection while still retaining sufficient upside? And then two, how do you make sure that they think that you're able to execute at least on par with what they're doing, or even better, given that the company is like combined? It is like, one, we're probably also a bit lucky that it actually worked out the first couple of times, but it is like just the first time, just be mindful that it's going to take some time. And then until you kind of build up the credentials, like we know what we're doing, right? Like the fourth acquisition here is just like, we have a playbook, we'll apply it. You can literally see the track record from the other ones. And then it's just basically off to the races.
And based on the three you managed to close, were there like in some, I mean, I don't want to say difficult situation, but were there like companies that were maybe burning and they were like, okay, without them we will continue burning and we'll never switch to profitability? Were there some where, I mean, they've been building their companies for many years and didn't manage to break through? Was there some sort of component where they felt maybe stuck and you brought essentially some form of answer to their challenge?
I think there's part of that answer. So like, I mean, obviously the three companies we acquired were also startups, right? And even a startup, even if it's going well, so like one of them grew quite substantially over the last year, it's still a startup, right? So you're still kind of like, you're left in a very precarious position because you're growing, but you still need funding. You don't know if you can get all the funding you need. You know if you're going to continue to grow. So I think there's naturally a different set of dynamics when you acquire a startup versus when you acquire an established company. It's been running for like 10 years, has 20% EBITDA margin, etc. Right? I think that can work in both directions, right? Because at that point, it's still kind of like, there's massive upside for them potentially. Because if they continue to grow like they have in the past, if they get the funding they need, then all of a sudden the sky's the limit. However, there's also the flip side to that, which is that, I mean, it's a startup, right? All startups have like a non-zero probability of literally just going bust at some point. So then there is kind of like, there's this dichotomy between these two like chairs where they're always like, it's probably a little bit of both. So like one pulls in one direction and one pulls in the other, right? So yeah. I think there's some components of that, but startups are just a little bit different compared to like an established company, essentially.
Yeah. Yeah, makes sense. Startups are, often very different. Yeah, I mean, I'm just interested. You mentioned something earlier about negotiating earnouts, and there's a human element to doing
For
that.
sure.
And as you being somebody that manages a platform, I know that in the venture world, there's often kind of this desire to turn investing just purely into maths and numbers. How much do you think is still a human element, and how much can you do with or can you improve with mass and quantitative elements
Yeah,
and
I mean,
data, etc.?
yeah, it's a very good question and very prescient at this time. I think I always link it back to so I'm economist by education. In economics, there's a term called physics envy. Basically is that all the economists are envious of all the physicists because they get to do math to describe the natural world with these beautiful equations, and it's just like you write an equation and boom, you're done, right? Like this is how gravity works. There's no person for whom it might work a little bit different. So economics has gotten a lot math heavy, right? And I feel there's a little bit of a similar trend in VC where like the VC funds have like looked at Renaissance Capital with their medallion fund that's returned like 60% IRR since like the early 90s. They looked at Jane Street, Citadel, etc. I'm like, that sounds awesome. I really want that IRR as well. How do I get that, right? And then they're kind of like, what can we take from that? And I think if you want to kind of like go deep into those things, I think there's two things that are quite materially different. Even though both of those are like investments as asset classes, there's a liquidity aspect and then there's a human aspect. So the liquidity aspect is basically is that VC funds invest in stuff that's extremely illiquid, right? So VC fund, you'll tend to go in, invest over 10 years, and then expect like there's going to be an IPO or an M&A, but it's going to happen like 8 years from now, which basically means you put in your money, you work with the company, but you don't like trade out of like startup A to go into startup B, and then out of that to go into startup C, depending on what's hot right now. And that's just completely different versus like a quant, like equities market fund, right? For example, where you might hold like an equity for a few days or a week at most, and then you trade in and out, and then you get like if you get like a swing of like a percent on each trade, that's amazing. Whereas like if you get a percentage upside on each like trade in VC, it's horrible. So like there's a liquidity element that's just extremely difficult to kind of like transpose from like public markets to the venture capital markets, which just makes it structurally very difficult. And then there's a secondary piece, which is like the human element. You can do a lot of like the quantitative elements in terms of like describing what's out there, identifying potential companies, describing kind of the market size and stuff like that. But like the earlier that you go, the more the human elements just matters, right? So for example, if you go out and you invest in a company that's a month old, essentially the only thing you have to invest in is the people. Like they'll probably not have any traction. They might not have a product. If they have a product, you basically can't test it. So the only thing you invest in is people. And if you invest in people, you basically have to analyze them, but you also have to talk with them. Because if I invest in someone, I have to work with these people. Coming back to the liquidity question, you have to work with them for like 10 years. You might be on their board. You'll have shares. You can be extremely annoying if you don't agree with like the direction of the company. You might even be able to help or to instigate a firing of the CEO. So it's very important that you work well as a fund together with the company. And that goes for both sides, right? You want to make sure as a fund, you have companies that you can work with. And as a founder, you want to make sure that you have VC funds that you trust and you trust it is in your best interest and can give you advice, right? So I think you can, going back to your question, Marcus, I think you can automate a lot of kind of like the work leading up to the actual investment. But there's just a human element that's extremely difficult to take out because you have to work with these people. And obviously, everything here I'm saying is like with the caveat that it might be completely different in 2 years because of kind of like the rapid evolvement of AI. But at least right now, that's the way we see it, which is also why we don't see ourselves as like displacing a VC fund, because that's just then you're completely removing the human element, which is just so important.
Yeah. That makes a lot of sense. And I mean, I guess when you approach the human element, are there still parts that you might be doing maybe subconsciously, or evaluations, a checklist that you're going through subconsciously to pick certain things out? Like, is there anything that you use when you're identifying these opportunities on a human level that you could maybe discuss that you look for?
Yeah, as I think the way we do it is much more of an exclusionary. So we come at the problem from two perspectives, right? We look at the company, is that relevant? And then we look at the founders secondly, actually. So the company we
Okay.
go in and say like, is this company essentially relevant to a VC fund? And the easiest way of doing that is actually first to exclude a bunch of stuff, right? Consulting companies, not relevant. Brick and mortar stuffs, not relevant. Like some ecom, but it has to be very peculiar ecom, right? So there's just like a large number of categories of companies that are just not relevant for you as a VC fund, right? So all of those you screen out. And then the secondary piece we look at is the founders. And then on the founder side, we look at like, what have you done in the past? How much does your experience, education, kind of like what you've done, how much does that match a typical successful VC-backed founder? And that's obviously, it is our perspective. And that is a lot harder, right? That's also where we basically put it back in your hands and say like, this company is potentially relevant. It fits your investment thesis. We think the founders are particularly strong or not super strong, but it's up to you then to make the final evaluation. And the only way you can make that final evaluation is essentially to talk.
Yeah.
So how do you evaluate if a founder is strong or not? I mean, what's my score?
I was going to ask
What's
the
my
same.
score on Evertrace?
Yeah, I mean, naturally, Evertrace is on Evertrace because we founded the company when we started. And actually, we had to massively pump our own scores because otherwise it'd be terrible. So, I mean, I think what we basically do, it's actually quite simple. So we come at it from like a generalist perspective. It's just what are the typical kind of spikes we see. So we are much more focused on like, it's not like you've done like 10 things that are kind of okay, you get a high score. It's much more spike heavy. So if you've done something that's extremely impressive, that'll tend to bump up your score a lot more than having done like 10 things that are pretty impressive. And I think that's probably also the way I would prefer to invest, is just invest in people with extreme good capabilities in some aspects, and then it's fine that they have deficiencies in others, right? So you don't have like on average it's good, but then that means that there's no kind of like outlier, because at the end of the day, VC space is about outliers, right? So it's about like finding something who can go like not just 2x, but x.
Mm-hmm.
So that's also the way and the methodology you apply to scoring.
Oh, I mean, I guess it's some form of indication too. It's not like, I mean, you don't pretend that, I mean, as you said earlier, that you are spotting like unicorns,
Exactly.
founders. Okay. So let's say, I mean, so what would be the space for like maybe new GPs, new investors? I mean, because I guess, I mean, I've seen some decks like for, funds raising new funds, or maybe first-time founders, etc. So very often, a big chunk of the value is on the sourcing aspect. So I'm connected to those communities.
Yeah.
I know them well, etc. You should essentially bet on me because I have that access. So I have the key, plus, I have the knowledge to understand what I'm talking about.
Yeah.
With Evertrace, you essentially, as we said earlier, the first part is, I mean, essentially me, I'm going on Evertrace today. I can, tell people I have like access to a huge potential deal flow. So what's the space for new GPs? You think it's probably related also to like general like macro trends in the market, where you tend to have a consolidation of or private equity firms in the large sense of the term. So most probably also with VCs, where a lot are not necessarily successful, so will disappear. So how do you see the future of venture capital in terms of as a business, really?
Yeah, so I think there's multiple answers to that question, right? I mean, and mine is just our perspective. I think the first thing is that VC funds tend to move earlier. Things are growing extremely rapidly. So companies that before used to take a few years to reach or go between seed and A or pre-seed and seed will now take sub a year, right? That's also why you see like companies literally raising multiple rounds in a year. So because kind of the speed of revenue, the speed of companies have increased, the only way to kind of like capture that is to go earlier, because otherwise you're just never going to hit the right companies because it goes so fast. And if you're not talking with them when they are created, or at least very early on, it's going to be extremely difficult to get in at the later rounds, even if you're an A or a B fund. So I think the first thing is just kind of like you're going to move earlier. And I think that's what we see across. We also see funds now who are our customers who used to mostly do A and B, but then have started moving to seed and started moving to pre-seed as well. So there's a speed element that's definitely kind of getting sped up. And then the secondary piece is just kind of like I think, as you said earlier, Thomas, like the whole, I have access to these communities, so I'm going to get good deals. There's still a little bit about that because you might, like, your network is still a good indicator. You can get things that are even earlier than any other publicly available sign. But I think that, like, the alpha in that pie is just a lot smaller. However, what that still allows you to do is that it allows you to have much more like knowledge about that like very peculiar industry. So I think my guess would be that you're going to have those big generalist funds, right? I mean, A16Z, Excel, Sequoia, etc. I mean, one, they have the capital. Two, they have the brand name, and three, they also have the people to continue to be the generalist fund. But I think if you want to win as a small fund, being a small generalist fund, you're just going to get eaten. So then the only competitive advantage you're going to have is to be super narrow, super targeted. I want to see all the deals within this particular space. And then I'm okay that it's not only in Denmark. I'm okay that it's in France, or Spain, or even the US, because we have access to tools that enables us to surface founders from a much broader perspective. So because, for example, Evertrace allows you to easily surface founders in France, even though you're in Denmark, which is something that was very difficult in the past, that also means that you can actually narrow your scope because you still have a good deal flow. Otherwise, if you're a Danish fund, you basically have to be generalist because otherwise there's just not enough deals in Denmark. So I think stuff like this enables you to have a much more narrow scope, again, which should make you better able to predict what companies are the right ones.
Interesting. Yeah. So, and you just mentioned that more and more funds are going earlier, in the process. So going from, maybe they were Series A and now they're also going into pre-seed. Do you think that's like a natural result of maybe the amount of capital that's required for some of these deep tech businesses or, AI businesses, and that they want to be involved in the follow-on rounds, or why do you think this is happening?
I mean, I think as anything deep tech is just, one, it's difficult. Two, it's very capital intensive. And three, it tends to be capital intensive from the beginning, right? So that's also why you tend to see quite heavy rounds very early. Because I think that's definitely some component of what you're saying there, Markus, that hits the spot. And I think the secondary piece, as I said before, is just, it's much more that things are just speeding up. And when things are speeding up, it also just makes sense to make the rounds larger. Because if you know that the alternative is just literally raising in like 9 months again, let's just put more cash in on the table now, get a better evaluation if I have extremely high conviction that this is going to be the right bet. And that just, it speeds up two things. One, it speeds up the round, like the amount raised per round. And two, it also dictates kind of when the investments happen. And that will just tend to push it earlier.
Yeah, that makes sense. Yeah, very interesting. Moving on a little bit to the journey that you had yourself in your background. I know you already mentioned before briefly that you were at various places before studying business. You were at Bain, you were at Rabobank in the M&A space. So how did this, I guess, disciplined like high finance toolkit translate to now the maybe a little bit more chaotic early days? Yeah.
Yeah, no, it's a very good question and something I actually thought quite a lot about. And I think there's two aspects to it, right? In consulting, banking, investment, it's just you have to apply a rigorous process to a place that's quite rigorous, right? So rigorous process plus exactly what's going to happen. It's like in 2 weeks we have a steerco meetings. 2 weeks after that we're going to have the final steerco meetings, and then we have a workshop, and then it's done, right? So you know kind of like what's ahead. In order to solve that, you have to have a rigorous process because otherwise it's just going to get run over. But I think you can actually take that rigorous process and still apply it in a startup environment, which is just by its nature much more chaotic, right? Like every day there's like new things that are happening. But the way we think about it is we're still extremely rigorous about how we run it, how we run the startup. And that's, we experiment a lot. So like what works, what doesn't. But then the moment we find something that actually works, then we put it in a process and then we run with it. And that's also, I mean, as I said before, we're only 3 people, right? So that means that we're actually able to scale a lot because we identify individual processes that really works. And then the moment it works, we just basically start it. And it's the same approach we have to M&A. It's the same approach we have to go to market. It's the same approach we have to customer calls and so on and so forth. And it's also like our demos in the beginning was like 45 minutes because they were much more exploratory. It's like, then we do this and this and this. And now they're like 20 minutes. And they're much better. because we know exactly what points to hit. We know what to talk about. We know how to do it. And that also means we can take more demos. There's a higher conversion rate, etc. So I think we're trying to apply a very rigorous perspective or like a very rigorous process to something that's just inherently chaotic. One of my friends who works at another startup actually described Evertrace as like basically being run like an Excel sheet. And I think there's like, yeah, I think there's some truth to that. I think that's obviously putting a little bit of a finer point on it. But I think there's some truth to it, right? It's just we go in, it's like, okay, this makes financial sense to do it. Let's just do it. Like, and this doesn't, so we don't, right? So there's very much experimentation, but then we just kill things early and then we run with something else.
Yeah, and I'm just curious, did you ever feel like you had to unlearn, I guess, some of the consulting instinct, to overanalyze and, look into a lot of detail just to get stuff out the door and ship and start working on the product?
That is for sure, though, because I mean, in consulting, there's very much like there's a term in Bain which calls CD or zero defect, which basically means like whenever you deliver anything, there cannot be anything wrong with it. Like spelling mistakes is a problem, blah blah blah. That is not the approach here, right? It's just like it's done, great, ship it, and then like if there's an issue with it, we'll figure it out later. So I think definitely you're right on that part, Markus, that there is some things to unlearn, or at least just kind of like be rigorous in a different area, right? Then you're just rigorous around testing and then shipping. And then the moment stuff is ready for shipping, that's fine. Then you ship it. And if you're not embarrassed about your first release or when you're releasing stuff, you probably ship too late, right? And it's just one time we actually spent quite a long time on a new product and then we pushed it, no one used it, and it was like, okay, fine, we could have figured this out in a week instead of a month.
And so regarding so you mentioned, okay, so we shipped a feature, nobody used it. And did you kill that feature 2 weeks after, or it's still there and nobody used it?
Yeah, I mean, we killed it, right? Because it's just the problem about having nice to have features just like laying around is that at the end of the day, it still requires stuff. Like you might not develop it, but then it still breaks and then you have to fix it. And there's like one person who uses it. And if it breaks for that person, you're just going to get like endless amounts of emails from that person. So I think that's one. And then the secondary piece is that people tend to evaluate a company or a product based on the worst aspects, right? So you could have, if you have a product or a platform that does like two things, the 90 or 99% value is derived from one thing, but the 1% value is derived from something that continuously breaks. The only thing I got to remember is that like, yeah, this platform was continuously broken for this one thing I never used. So it's much easier to just kill it and just forget that month you use on it. And I think that's...
I guess that would be one lesson on the product side. You ship fast and you need to kill features fast too.
Yeah, for sure. Like I think that's kind of like the experimentation part, right? And whenever we've taken too long, we've always regretted it. Obviously, you can't rely on one set of feedback because then you might be wrong. But if you get decent feedback that this is probably not working, then it's just time to not massively pivot, but tweak. And if you can't tweak, just kill it and then do something else.
Okay, that makes sense.
Because I mean, there's always tons of stuff to work on.
And so maybe so again, restricted team. You mentioned product. What about the go-to-market? So when you had essentially the idea, I mean, first, is the concept of Evertrace today the same as it was at the very beginning, or did you have to, as you said, tweak it along the way? And then how are you running go-to-market sales? Is it mostly outbound, inbound? I mean, I guess you had a decent network, so as any founders or, ex-VCs, but, how did this happen, on the sort of concept, number one, and then number two, at the go-to-market aspect?
Yeah. So, I mean, if I just answer the first question first, Evertrace is essentially, it's not the same company, but the mission is roughly the same. I think the only thing that actually has changed is that we've cut products. Initially, it was we're going to have founder detection. We're going to have a company database. We're also going to have product signals. So we had a larger suite of products, and that was fine. But also you can see on demo calls that then you have to explain everything. And then you have to say we're working on that. It's going to come at some point. Now we killed that. So we still have the same product we started with. It's just a lot better. And it's the only thing we do. It also becomes easier to tell the story why we're better, because that's the only thing we do. We don't have 6 different horses that we're riding on. We have one. So the same, but just actually just slimmed down, right? Instead of like expanding, we basically just slimmed the product even further down. And then on the secondary piece, which is the go-to-market strategy, our go-to-market was a little bit odd in the beginning. So, I mean, the largest VC market is in the US, right? So you tend to think that you start there. The problem is just kind of VCs are a lot kind of like, because they're used to talking with people, they like to do deals with people they know. And we just knew more people in Denmark. So we started in Denmark. We knew secondary most people in Sweden. So we went to Sweden, and then we just kind of like expanded concentrically from there. And in terms of like how we run this, we do outbound. We also do some ads and stuff like that. But actually, the vast majority of our demos, they come through our existing customers. So VCs are like notoriously good at talking with each other. They'll have like 1,000 chats with 1,000 different associates. Like, what are you using for? Like, one is like for deal sourcing, and two is just kind of like to gossip around, right? And we've just seen like once we actually get a foothold in a country, like it explodes there, right? So after we acquired the 3 companies, 2 of them are based in Germany. Our German footprint just started exploding. Then we got into France with like 4 or 5 funds, and then our French footprint just started exploding. So we have kind of like, we go in a place and then we expand. And then once we hit a critical mass, they'll start referring each other. And then we get to see that the number of demos coming from a specific area just skyrockets. So just to answer your question quite pointedly, Thomas, like, yes, there's some outbound, there's some ads, but actually most of the high potential leads we get is from our existing customers, which is, okay. I mean, one, it's like low effort. Yeah, exactly, right? It's the best because it's just, 1 is low effort, and 2, it has the highest conversion probability because it comes with like a pre-stamp of approval.
So you can tell your clients, if you also do the demo, we will give you like a 25% discount, and this is the type of contracts you need to have them sign.
We actually considered doing like a referral program, and then like $100 to Patagonia, because that's the secondary thing that every VC loves, which is Patagonia. so like I think that also
did it pick up? Did it pick up?
We're not doing it yet, but we are implementing it. We're actually considering it quite strongly. And I was like, we're sitting around the table like spitballing, like what we should do is like, we could do like Nike, or we could do like whatever, like cooking classes. Who cares, right? It's like Patagonia. It's just like, if there's one thing all VCs love, it's Patagonia.
It's a good. I mean, it's also a super good sign that you know the industry really inside out.
Yeah, exactly right. Literally know their clothing habits. And give everyone a deal vest. That'd be great.
Yeah, the financier.
Exactly right. Deck everyone out in Patagonia.
Yeah, I read somewhere recently that 2021 was kind of almost like a extinction level event for a lot of VCs. I think something like 25% have basically gone out of business since then. So, I mean, do you feel like you're selling to an industry that's consolidating quite aggressively? And kind of how does that affect your like total addressable market? And, how, do you think that's going to shrink it or increase it?
Yeah, it's a very good question. So I think first of all, like 2021 is like a real outlier year of like every conceivable metric, right? So I think luckily we have it's true that after 2021, compared to 2021, like the number of VC funds have gone down quite aggressively. However, that's also because it like exploded in 2021, and I feel like everyone could raise a fund. So I think we're getting a little bit more back to like normal. There is kind of, I think we're naturally susceptible to kind of like boom and bust cycles, just because like when there's hype, there's more funds. When there's more funds, there's more clients, and so on and so forth, right? So there is like some level of circularity or cyclicality in our business model. However, the good thing is that VC funds tend to last for a long time, right? So they'll raise capital for like 10 years, and then they'll deploy that over 10 years. And then sure, some years have like fewer funds being raised, some years have more. But VC as an asset class, especially during this AI boom, is starting to pick up. And it's also starting to pick up in a way where like we feel like the VC funds are getting smaller in some aspects. And that's great for us because we much prefer like tons of small ones who have our tool than like a few ones who have our tool, right? So I think there are some elements that very much talks to us, and then there's some elements that's a little bit harder just in terms of the cyclicality. And then the last piece is that we're quite strong in Europe now and started to go into the US, but there's like tons of market still to go, right? So even if you slice like 10 or 20% off the top, like we still have ample room to grow. So like we haven't remotely hit a ceiling where it's kind of like you're basically just growing with the market.
Yeah. That makes sense. And do you think there's any threats like coming in? Like for example, AI is that a threat where I guess maybe in 2 years you might be able to ask a model to do some deep research and just scope out the general landscape. How do you address threats like this? And do you think there's any other threats next to AI?
I mean, first of all, what happens with AI in 2 years is like, I mean, that is a guess that I'm not prepared to make because like I feel like that is very, very hard. So like, I mean, on that, Markus, you might be extremely right that in 2 years we just like done because AGI or whatever. However, like already now some funds are using AI, but it's quite hard to use it to find new companies for multiple reasons. One, you basically need a framework around it, right? Because if you just ask the AI every day, it's like what new companies has happened today. You'll tend to get the same companies from yesterday. Then you have to have like a massive context. You have to create essentially a platform around it. At which point you're basically starting to become like a mini software company, right? Which is just kind of, is that really worth it versus just buying like someone who does it bespokely, right? So it's quite hard to do it just based on the models that are out there right now. And I mean, it's not like we're charging like $10,000 a month. So it is like at that point you still need some internal stuff. It's like, do you really want to keep this internally? You have to continuously update it, etc., etc. Or you just want to take something that's off the shelf that serves exactly what you want. So I think that's point number one. Point number two is that there's quite a lot of these things which are not behind paywalls, but they're behind APIs. So in order to get access to the Danish trade registry, you need like an API. And it's not that API is actually free, but you still need an API key, right? And it's the same with like the French trade, it's the same with the Belgian trade registry and so forth. So there's a lot of this information which is just publicly available, but it's gated behind some infrastructure that you just need access to. And then again, sure, then you could go out, get access to this, toss it in a model, and then it might produce an okay result, but it's very unlikely it's going to produce as good a result as what we're doing because it's the only thing we're doing. So I think there are some aspects that you can eat around the edges, but it's very hard for like a generalized purpose model to take over the space because it's so niche, which incidentally is one of our best modes. At least that's what we talk about internally, is that we're not just doing like investments, right? We're not also just doing investments with VC. We're doing investments for early stage, like very early stage VCs. So it's such a niche thing that it's unlikely that an AI or like a model, any given model, is just going to randomly pick it up in a meaningful fashion where it solves the needs that you want.
You do use AI. There is AI within Evertrace too, in some way. But I think one of the first like fund that developed some form of AI in the sourcing and analyze of deal flow, etc., is Quantum Light, like the fund from Nick Stromsky, like from Revolut. Do you have some insight on their own solution? So it's not solution, but on their own product. Like, how does it work? I don't know if you had like some discussions and can give some light on what they do.
Yeah, so two things on that one. As you said earlier, Thomas, yes, we use AI aggressively because we use it to analyze, because we use it to analyze everything, right? Whenever we have a company, we are not analyzing it personally. It's tossed through like our own internal models, but it's also tossed through like external publicly available models, right? So we use it extremely aggressively. On the Quantum Light aspect, I think they're an A or B fund, so they're outside our scope. To be fully transparent, I actually don't know what they're doing. I know that they're supposed to be quite quant heavy. My guess would be that they use quant in order to analyze the companies. So it's probably all the data. I mean, at an A or B level, you start having data that you don't have on a pre-seed, because in a pre-seed, it's just, as I said before, it's like two guys and a cat, basically, who's created a company. And so there's just not data beyond like where did they go to school, basically. But A and B funds, it's just, you start having revenue data, you start having customer data, product data, etc. My guess is that they're using AI or like machine learning or much more quantitative heavy methods to analyze this. And then they're probably also doing the same with markets. So it's like, what trends are we seeing in the markets? How does that fit with this particular company? But like anything beyond that, I'm not 100% sure.
And so for you, I mean, two questions based on what you just said. So maybe Evertrace is more tailored to earlier stage funds today, but you do have like within your clients some, later stage funds too.
Yeah.
So what made them come? I think you
Yeah.
have Creandom within your super happy clients. I mean, what made them come? Because I mean, if you focus on later stage, I mean, you may, or maybe it's related to what you just said earlier. I mean, it's very important for them to have very early days information to build up your pipeline for the next 3 to 4 years. Maybe that's the reason. Maybe
Yeah.
I'm just
That's, I mean,
responding the question.
yes, exactly. I mean, you made a very good myself impression there. That is roughly kind of like the argument that they're making. Is just it is a very cost effective product for us, and then obviously they're not going to go as deep as other companies or like other funds where like you want to see everything within these like 10 verticals. They'll be like, I'll see the top founders, the one with extremely interesting backgrounds, done stuff before. I just want to make sure that they're on my radar. And then it's fine if I only get like 5 leads almost a year, because then I can pick up conversation with those 5. And that I know that they're very likely, just based on their name and their background, to raise at least a seed round and possibly an A round, right? So then like the kind of, what can you say, like the bar for when it makes sense for them to jump on is also lower, because they just need like 5-10 founders, because they don't need to invest in 40 companies over the fund's lifetime.
Makes sense.
So yeah, essentially what you said.
And so maybe like a longer term, like, so what's your vision? So you're focusing on earlier stage. Is your, I mean, do you want in the near future to start deploying product more tailored to A and B funds and maybe go up
Yeah.
essentially the ladder? Is that part of your plan?
Yes, so very much actually. So I mean, as I said before, we consider people signals, identifying essentially what companies are out there. We just consider that a descriptive problem, which basically means it's a solvable problem. Like at a certain point, we basically describe the world sufficiently clearly that these companies exist, these like backed by these founders, like created by these founders, etc. That is probably 6 months away from us, and then we're like 99% there. So there's very limited additional kind of like stuff we can do. We can naturally continue to automate processes and stuff like that, but the data foundation is actually more or less done. And then the kind of like the natural progression for us would then be to move into investment data. So that's kind of like where you start playing against the PitchBooks of the world, basically like who has raised round, right? We'll probably go at it at a similar pace where like it's feed based, like these are the rounds that are coming up, much more than massive database that PitchBook has. And that also, it's a nice way up, because it hits like the pre-seed funds are typically pre-seed and seed. So they'll also want to know what companies has raised rounds, at least the early stage, right? So we'll hit like existing customers, and then we'll start hitting the A funds as well. So we'll be able to kind of like much more upsell to existing ones, and then just like slowly progress into A funds, right? And then after that, then you can start making like tools and platforms and stuff like that to make it easier for them to evaluate. So there's a nice natural progression of the platform and the product that we're building over the next 1 to 2 to 3 years. There's ample roadmap, ample stuff to build.
You mentioned PitchBook, so is that a one of the competitors that you're working with? I mean, are there any other competitors that you see in the market, and what makes you better than them, essentially?
Yeah.
What's your secret sauce?
Exactly. I think that's a very fair question, right? It's like one of the first things that everyone asks us. I think there's like a few answers to that question. One, just PitchBook is like, it's typically more late stage. So I mean, you can't really use PitchBook for pre-seed, because by the very nature, pre-seed hasn't really raised money. So PitchBook tends to be a little bit like later than us. So we don't really see us comparing to PitchBook. It's much more like we'll have Evertrace and PitchBook more than we'll take Evertrace or PitchBook. There are some competitors out in the market. Now we've bought some of them, so now there are fewer competitors in the market. Nice.
Good moves.
Yeah, exactly, right. That's always nice. There's a competitor in the US called Harmonic. There's a competitor in the UK called Spectre. Both of those are a little bit later stage. At least they focus some on early stage, but it seems like their sweet spot is more Series A, Series B funds, so like a little bit later stage, and also feels like, at least according to what we hear, that they're moving a little bit up the market. And that very much actually is our competitive advantage. Our competitive advantage is that this is the only thing we do. It ties nicely back to why we haven't raised all our money, because this market is quite small. Like, there's not infinite amounts of like early stage funds, right? That's one. Two, early stage funds tend to have like lower AUM, so asset under management. And the asset under management is essentially directly tied to how much money they have to spend on like wages, tools, and stuff like that, right? So like a massive fund will have more money to spend on tools, and a small fund will have less money. That also means that our market is just not like the market for pre-seed fund is just smaller than it is for Series A, Series B, Series C funds, because they have to be massive in order to write the checks that are required at that level. So our like we see it actually as a competitive advantage that it's a small market. It's the only thing we do, and it's the only thing we'll continue to do, and we'll continue to serve this extremely well until it's basically like 100% there. Which is also why it comes back to a little bit what we talked about earlier. That is the reason why we have to raise venture funding, because I mean, venture funds, right? They're looking for not only a category winner, but a category winner in a sufficiently large market that they can make like 100x return. And it's very, very hard for our company to become a unicorn. Like a unicorn is like an arbitrary number, right? But it's very hard for our company to become like a very large company because our market is just not there. Yes, when we start growing into like A, B funds, it becomes larger. But even then, it's still quite limited just because in case you want to make a real VC fund, like a fundable case, you probably have to go into like private equity, real estate, stuff like that. And that is just not, it's like two adjacencies away from our core.
Well,
So
you should never say it's not possible. I mean, like this week, I spoke to someone at Carta, like, who told me about, who gave me a bit of their story. I mean, it started essentially as just like managing your cap table online for startups, which you think is, I mean, you don't understand like the
small.
big thing. Yeah, you don't really understand what can be big. And then essentially, because they started seeing like those, funds getting, logged in the system to manage the cap table too. I mean, they started identifying other types of problems. So you never know. Still the early days for you. I mean, I'm a big advocate. I don't know, like I have a good vibe
for sure
with you guys. So I'm sort of emotionally biased in some way. Maybe getting back to one of Markus' point on your secret sauce. Something I'm wondering. So I think I don't know if it's you or Simon, your co-founder, but on LinkedIn you published something where you mentioned using unconventional data sources. Can you give a few examples? And out of those examples, is there a way where, for example, I mean, you have like 150 VCs connected to your platform on a daily basis. Let's say like suddenly 15 of them start, clicking on Markus because they think he's an awesome, entrepreneur with awesome ideas, which he is, like, for sure.
I'll take it.
Do you, for example, take that data and tell the others, by the way, there is that person being checked quite a lot? And do you take that data as unconventional data to tell other people, that might be like a good place to look for gold?
Yes, I mean, so I mean, it's a question we've gotten before, right? Essentially, the question is like, as a VC fund, do you use the data I provide you for any, like, do you give that to anyone else? And quite purposefully, we do not do that, because at that point, you're disincentivizing funds to use the platform in the way it's meant to be used, right? Like, people then might scroll through and then it's like, oh, this guy looks cool, and then they'll like externally figure out who he is instead of just like doing it through the platform. So it's very important for us that all of our customers are like 100% sure that any data they use, like they share with us, we do not sell it, we do not share it, we do not use it for any commercial purposes like that. And also, like, I mean, people connect their CRM system to easier flow. We don't touch that. We don't look in it, anything like that. It's just like, that's like forbidden land. Don't want to go there. So what we much more do in terms of unconventional data sources is that we go deeper on specific things, right? So, for example, we look at patents. So we hook up to the European Patent Office, and then we evaluate all the patents that have been given over a day, and then we do that every day. And then it's like, have these patents been evaluated, or has these patents been given by a company? If they've been given by a company, they can't really become a new company because they're owned by that company. Are they by a university institution? Are they by a person? Then they start to potentially be interesting. So then we slim that down. And then we look at the patent. Is this patent potentially relevant? And then we kind of like put that through a funnel, and it's like, okay, now these guys have created a patent. This patent appears to potentially could like lead to a venture backable company. Then start looking at it. So that is much more what we mean when we say unconventional data sources. We also look at GitHub, for example, people talking about building stuff on GitHub. Those people we also look at. And then the biggest, I don't know if you want to call it unconventional, but the biggest kind of like quote unquote unconventional data source is the TradeRex, which is basically like a gold mine, because everyone who has a company basically has to register it somewhere. Otherwise, it's not, you can't receive funding, you can't receive revenue, etc. So all companies that exist, more or less, at least in Europe, needs a registration. And that is an extremely valuable piece of information, because then you can go in and say, like, is this company relevant? Who is it registered by? Is this potentially VC backable, right? And that makes it very easy, like once you've gone through all the hurdles, to essentially provide VC funds with very actionable, completely newly registered companies, because that's typically one of the first things you do when you want to start a business.
Okay, and maybe like so follow-up question on this. So I think recently you launched like a plugin for founders to be able to essentially distribute their own details to your portfolio of clients. How does it reconcile with maybe the fact that you don't want to essentially hijack your own objective information flow, etc.?
Yeah, I mean, so anyone who signs up there, one vast majority of our deals, or not deals, but like our potential investment opportunities come through we've sourced ourselves. But there are some that comes from kind of like basically our version of inbound, right? But anything that gets inbound to us is run through exactly the same flow. So just because you kind of like you sign up there, it's amazing, because then we know that you exist. And then we evaluate, is this person relevant? Or is this company relevant? How does the background look like? So there's kind of no steps that are skipped. They just basically jump into the queue. The only difference is this, that they make sure that they're inserted into the queue.
Okay, makes
and
sense.
then the
So
secondary
it's
piece,
more a way to make sure that you are in the market
yes,
for raising funds over the next 12 months. Okay, understood.
Yes, exactly. We don't like push people like or like promote them in a particular way. It's just everything goes through exactly the same channels.
Is there a way, like, so maybe that's maybe completely out of topic, but I mean, I'm sure you'll start probably receiving some sort of proprietary deal flow. Being in touch with so many investors, and on the other side also like talking to founders. Is there a way for you to develop maybe a service which is, I mean, maybe not so scalable, but I don't know, like where you essentially introduce like investment opportunities to funds, where you would be some sort of not an M&A advisor, but some form of a raising platform?
I think that's a little bit similar. I don't know if you know the company called Bordy. It's a little bit similar to what they feel like they're doing, where they're a connection layer between kind of like people who talk to Bordy and then is looking for money, is looking for capital. And I mean, to some degree, that's also what we do, right? We identify potential investment opportunities, but then we just present them directly to you as a VC investor and say, like, you pick and choose here. I'm not gonna push anything, but just like you pick and choose. And I mean, there are obviously pros and cons to either or. I think the pro of doing it this way is that it becomes not a more objective, but it becomes more holistic, right? Because the trick, it's a little bit similar, like what Bordy is doing is super cool. Like I think the tech is like quite cool, but it becomes quite similar to inbound from a VC perspective, right? The people who will talk to Bordy, they'll tend to be like the ones who haven't gotten like 1,000 inbound offers in terms of like potential investment opportunities, right? So there is some selection bias that could turn out to be like to the left or to the right side. And then there's a secondary piece, which is that not everyone, like the vast majority of people have no idea how to, like, not only how to raise money, also like who should I talk to, who should I call, what should I do. So then it's much easier to present their information to the people who know how to talk with people about raising money, right? So that's basically just like, these people are potentially in the market for raising money. You tell that to the venture capital, who is the ones who would end up giving them money, and then they make the actual decision and kind of like tie the loop of that way.
Okay, that makes sense. And so what's on for 2026? So you mentioned a few like product updates, like maybe a bit more M&A, but what's on for 2026? What's your wish list?
I mean, our wish list is like finalizing 3 to 4 M&A targets. That might be a little rough, but that's on the M&A side of things. Finalizing people signals. So like basically making that problem, essentially mark that as solved. Finalizing all the workflow builders, the automated outreach, stuff like that we also talked about earlier. Essentially taking kind of like as many manual labor functions and then just putting that on autopilot, and then starting building up the investment signals. Like I think if we can execute on each of these elements concurrently, at least from a product side of things and a strategic side of things, like that's extremely, like at that point we just like we ticked off a lot of boxes. And then obviously on like the commercial side, well, one, just continue to grow in Europe like we have, especially over the last 12 months. We grew by like 18% month over month in 2025. So if you can continue with that, that would not be bad. And then like kind of like the way of doing that is very likely to go into the US, right? So right now we are live in the world. So we have customers in Southeast Asia, we have customers in Australia, New Zealand, and the US. But like the main portion of our customer base is in Europe, right? And it's not really a secret that the VC market in the US is just 4, 5, 6x what it is in Europe, right?
Mm-hmm.
So really penetrating the US would materially accelerate this plan. And one of the ways of doing this would essentially to be buying a potentially smaller US competitor. And then using that, coming back to our go-to-market earlier, right? Using that as a way in to then spread kind of the word, right? Because then you put Evertrace in the hands of a ton of users, and then they get to go out in their network talking about our tool, which makes the inbound go-to-market channel so much easier. And so like I think there is some flywheel that naturally kind of like spins the right direction once you get it going.
Okay, no, makes sense. And so do you plan on hiring anyone, like, because or when you acquire, I mean, you do keep people in, I guess?
So what we typically do is like we keep people on as advisors, just especially in the integration period. But then otherwise we keep a pretty lean team of 3 people. If we were to hire more people, we'd probably just hire more people on the engineering side of things. We have like we're a few people doing sales, a few people doing engineering. Right now, I mean everyone works quite a lot, which also means that you get quite high leeway out of running a lean startup, right? And I think we'll probably never become like, or at least the idea is not that we grow to like 200 people, but much more that we have a small team of very highly capable people in their particular niche. So like, I mean, in terms of hiring, we might be hiring a few people, but we're very, very selective and very, very conscious of who you hire because it just adds complexity, right? And right now we can move so fast because people own specific things. They don't really report. It's just like if you want something, you do it, and then you can execute it on it extremely fast. But if you start like building an entire engineering organization with like 4 people, and then every person has like 2, 3 people reporting into them, it very quickly just get lost in bureaucracy, right?
Mm-hmm.
So on purpose, we push extremely fast, and we're very conscious of whether we hire people or not. So
Okay,
to
understood.
answer your question, maybe.
Yeah, you'll see.
We'll see, basically.
Yeah.
And so maybe to essentially, I mean, close the conversation. What are maybe like the 1 or 2 greatest lessons you've ever learned through your career? You know, even like pre, and you know what you've learned so far, like building your own company.
Yeah, I think I actually think about this quite a bit. I think there's like 2 things. One, don't compete. If you can avoid competing, don't compete, because especially if you want to compete in something that's standardized, you'll have tons of people who are also very capable. So if you want to go into like fintech payment processing, it's going to be 1,000 people. They're all going to be great at what they do, which means that you might win, but it's a hell of a lot harder than going into something that's more niche. So if you can compete, if you can avoid competing, that's much better. Try to build essentially a small monopoly in a niche. I like 1,000 times prefer that versus like going into a large market with a bunch of players. Everyone is well funded. Everyone is very capable. Always like compete, and then you could argue that it's quite ironic that I worked at like a consulting firm where it's literally that, right? It's tons of people like competing exactly the same way. But like, I mean, that probably also feeds into it, right? So I think like compete in non-traditional fashions is it's much easier and it's much more satisfying and it's much easier to create something that's sustainable and can grow extremely fast. And then number two is what we talked about earlier, just like if you have anything, like always just like action over inaction is always the right choice. Like if you can take a decision today and just like either on that product or commercial or organizational, anything like that, it's much better to do things and then just course correct than it is to like overanalyze, wait, hope that things are like turn out in a specific fashion. It's much better just do it and ask for permission or ask for forgiveness rather than permission. Especially in startup, that's just because otherwise you get bogged down into details that are just so hard to get out of.
Now make a lot of sense. But look, Jacob, on that note, thank you so much for your time. It was a pleasure. Markus, was great to have you on too. But really, Jacob, thank you so much. And all the best for 2026.
All right.
Thank you very much. It was a pleasure. Cheers.